2010, which you can just kind of see in the beginning. I was working on building a global macro trading program. And what that really meant was an investment program where we take positions in macro instruments like foreign exchange, interest rates, equity indexes, and energy. And in particular, energy, crude oil, and natural gas. And so we started trading our program in 2011, and by the beginning of 2013, I came upon an article on biophysical economics, and so I got very interested in it by virtue of the fact that we were heavily trading energy in the West Texas intermediary market, on the Chicago Mercantile Exchange, and also Brent crude, which at the time was traded on the ICE exchange. And so I came to the conference in the summer of 13 and got so excited about what I heard and what I learned, and came back kind of loaded with a new vision, perhaps, of how the economy might work. And we went to work on remodeling how we were trading energy from a macro standpoint. And we were looking very closely at how Asian demand was growing and driving the demand market. We were looking at the supply side and the supply constraints, peak oil, OPEC. And so we rebuilt our models. And by the spring of 2014, we came to the conclusion that, there's just not going to be enough oil. And the oil is going to end up being a rationing market with its price. And so our thesis was to take advantage of that. We needed to be bullish oil. We needed to really get aggressive oil. and so about mid-14, we started theorizing how we would put these positions on the derivative markets, and we'd make bets out 1 year, 2 years, why not 3? Because there's not going to be any oil. And so just about the time that we got all the positions on, the market crashed. And so that was what I got from my first Biophysical Economics conference and its application to the real world. So it's taken me 5 years to recover, and now I'm back. So thank you for having me. So I wanted to really quickly kind of go over what I'm going to try to cover today and my inspiration for this. No joking aside, we did get long oil, but we survived because we had risk controls in place. But I did get left with a new vision of how the economy works, how the macro economy works. And I really got interested in this first from a modeling standpoint, and then about the startup world in new projects that might start to address some of these issues from an energy standpoint. So besides looking at the modeling side, I've gotten involved in several startup projects that involve cogeneration, ground transportation, and building mechanical systems. And they all kind of have a common thread in terms of energy and our use of energy. But today, when I saw that the conference was out and I submitted an abstract, I wanted to bring something out for us to talk about, and specifically I wanted to come to see if there were people that might want to work on this problem with me. And so my goal today is to take us through an idea of, can we build a model, a benchmark biophysical economic model, with an idea in mind that we want to have institutional buy-in, and we ultimately want to affect policy. So my thinking is that until our work can be implemented in policy, it's really just academic. And so my interest and passion today in this presentation is to talk with you about that. And so let me get started here. So the goal is to create a benchmark model with biophysical economics. And some very simple ideas is it needs to be based on this new vision of how the macroeconomy works. We need to make it simple initially. So we don't want to get bogged down in hyper advanced mathematics and supersets of assumptions. I think we need to start simple, and we need to try to pick up the relevant dynamics, which are all the things we talk about at these conferences, was essentially is how is energy, how is oil, and these other energy sources integrated into economics? How exactly is that going on? And I then want us, though, to embark on this project of building this model with an end in mind. And that end in mind is twofold. One is we want to have a model that we can put in our briefcase and we can take to institutions. So we want to build institutional awareness. And there's not just one institution that's involved in this issue and this problem. There are institutions in finance, there are institutions in transportation, there are institutions in agriculture, and each of those may require a different twist on the model. But today I'm going to be focusing on the financial aspect of this. And I feel like it's an aspect that we need to address a little bit more heavily with this group. And then the second is that once we get institutional awareness, we want to be a part of policy activism. We want to have a seat at the table. We want to be a part of how these decisions and policies are being made to change some of the behavior patterns that we're seeing, the consumption patterns in energy, and how energy is running through the economy. So the institution that I picked today to talk about is the Federal Reserve. And again, I want to emphasize this is not the only institution that has a stake in this game, but it's the one I'm going to focus on today. And the particular piece of policy that we're going to talk about is monetary policy, which comes out of the Federal Open Market Committee. So the Federal Open Market Committee is one committee within the Federal Reserve. And it is just simply one function of many functions of this institution. But I'm going to focus on it today because it is the piece of policy that is involved in regulating the macroeconomy. And therein lies where we want to talk about how do we meld the model with institutional awareness, because the Federal Reserve is building models and taking action and policy based on those models. So it's really important to understand that understanding monetary policy requires us to understand the operational details. And some of this stuff might seem boring, or why are we talking about this? But I believe that to have a seat at the table, to be part of the debate, we have to understand how the institution operates. What are its nuances? How do people get on the boards? How are decisions made? How is research cultivated throughout their system and brought up to these meetings? Who makes the macroeconomic presentations at the meetings? All of these details influence how policy is made. And then that policy has dramatic impacts on us. So the devil is in the details. And I believe that in building this model and embarking on that, we need to understand those details. And other institutions will have their own and other details as well. So I'm going to take us on a quick journey to talk about a piece of empirical economic research, very math intensive, that ended up into the policy pipeline, if you will, and then where that left us heading into the 07-08 crisis, and try to paint a picture as a base case of understanding how do you go from empirical work to policy to then implementation of that policy. And in this particular example, it'll be in the context of the 07-08 crisis. So we're going to start in 1977. There was a paper put out by Kinlan and Prescott. This was a very important piece of empirical work for you people who are publishers and research scientists. They won the Nobel Prize for this in 2004. So this is no small piece of work in the history of academics. But they published a paper on a subject about rules and discretion in making monetary policy decisions, even making a broader set of decisions. And what it was essentially this, that there exists some optimal decision at a point in time that maximizes social welfare, but there's also another path, a consistent path, a rule that is time invariant. So the optimal decision was discretion, and the rules, the consistent policy, was the rule. And their conclusion was, as a matter of a mathematical proof, that rules always trump discretion. So this was a major breakthrough in policymaking, in decision-making, in economic sciences. And this began a whole string of research, of mathematical models that took us forward. And the key implication of their finding was that expectations matter. That the economic agents will all be forming expectations about what our board, our policy board, is going to do. And they in turn will make decisions based on what they think the policymaker will do. Well, this was a major breakthrough. This was a major new way of thinking. And this ultimately had to be integrated into models. So expectations are all around us. One that I thought was interesting in Charlie's presentation about peak oil was how the expectation had changed due to fracking. So I just broke this up to look, what was the expectation for US crude oil production at this point? Well, this is where we went. So what was the expectation for US crude oil production at this point? And this is where we went. So expectations are changing. And I think that there is a piece of validity in that empirical work from 1977. The expectations do matter. And these expectations are shaping the way consumers make decisions about energy. And those micro foundations are ending up being macro outcomes. I want to give another quick example, because this one has really bothered me. I live in Atlanta, and we have a highway, Georgia 400, that runs north. And I included this because of the talk on sprawl.
Doesn't go south?
I'm sorry?
It goes north.
Well, for me, for my house.
Expectation.
And so it has always baffled me that people will sit in this line all morning, which of course is burning up fuel and taking time. And so I kept asking myself, what is the optimal policy decision about this? Well, in my mind, it was to extend our rail system. So our rail system stopped going north in the year 2000, but sprawl didn't. And so we recently had an announcement that our wonderful senators up in Washington had got us $140 million to study adding 2 more lanes, express lanes. And those express lanes are going to cost $1.4 to $1.8 billion to add 2 lanes out our major sprawl highway. Whereas we could add 14 miles of rail for about $125 million a mile. So I bring this up for a couple of reasons, because those are policy decisions that are getting set by a couple different institutions. One is our Congress, and the second is our Georgia Department of Transportation. So again, a set of institutions that are making policy decisions that are going to have a dramatic impact on what happens with energy. But they're also setting expectations for people. They're not making this decision because we think we're running out of oil. And they're not making this decision because they think the price of oil is going down. And that in turn is shaping expectations. So this brings us all the way to where we were before the financial crisis and how the Federal Reserve was making decisions. And all this work came together into something that was called forecast targeting. And it worked a little bit like this. As a central bank, you have to choose a policy rate. In our case, it's the Fed funds rate. It's the overnight rate of money. The next thing you got to do is you got to choose a path for it. You got to say, are we raising it? Are we lowering it? Are we keeping it steady? There's not a lot of options with what you can do with it. And you got to do it such that your forecasted target variables look good. And in our case, that is inflation. It's essentially price stability. And so to the extent that inflation is deviating from what they think the optimum should be, which is 2%, as measured by the personal consumption expenditures, you will either raise or lower and set a path. You should publish these forecasts, and you should justify the actions. And those last two really come out of this whole science of expectations, because to the extent that the public and the economic agents understand more of what the Fed is doing, they expect to have more control over the economy. And that control in their mind is getting actual monetary conditions to equal their desired monetary conditions. And so their method at this point is to attempt to move capital markets in certain directions to affect these outcomes. So all of this needed a model, because if you're going to be in the business of forecast targeting, you've got to make forecasts. So they came up with something called the dynamic stochastic general equilibrium. It was probably created by a mathematician. I know there's a few here in the room. Very simply, it was dynamic because it took into account time. It was stochastic because you could shock it. You could run tests through it. It was general because it was macro. And it was equilibrium because it was in the house of Walrasian equilibrium. So we had the DSG, and the Fed has developed one since the 90s, and it's called the FRB-US model. And it's essentially their version of the model. They claim that it's more accurate, it has more parameters, it's more sophisticated, except for the fact that it does a terrible job of forecasting. And it really can't forecast anything in the medium or the long term, which of course is the objective of price stability, is to be stable in the medium and long term. So I apologize that this slide is long, but it ties a couple issues together about our building models and getting involved in policy. At the end of the day, the Kinlan and Prescott work really didn't matter, because the reality is that policy is not done based on a rule or based solely on discretion. At the end of the day, the way it's practiced is people's best judgment. So I use this as an example of where hard empirical research ended up into policymaking and ended up into model building. But at the end of the day, it really didn't reflect what was going on at the board level. And this is the kind of error that I would like to avoid in building a new set of models. The new set of models that I would like to consider working on with this group would be models that could actually be used in policymaking, as opposed to ones that really don't fit the script. So along came the Great Recession, which we're all aware of. We know the numbers about, we know what happened. It's widely reported that it was financial, or was it thermal? And I'd like to suggest to you that the 07-08 recession, the roots of it were really an oil shock. It was an energy shock. And it took the financial community off guard because they really don't ever study it and they don't ever look at it. And they don't really have a way in their models with micro foundations to properly model the impact of an energy shock on the economy. And so this one got away from them. You can see it's not too hard to tell that our last major recessions were all involved with an oil price rise. I contend that the last one was the most dramatic energy shock that our economy has had. I think some of the best empirical research on this is by James Hamilton, but there are lots of issues that we can point at, that as the energy prices rose, car sales collapsed. And just that one transmission mechanism in the real economy had a major reverberating effect because of how big the car industry is in America. The second one was the mortgage crisis. It didn't necessarily begin as a financial crisis inside the city, but really on the suburbs, where transportation was a major component of the cost of owning that home because you had to make that commute I showed you earlier. Those were the first round mortgages that failed in the package derivatives.
Do you have a reference for that? Just
Yeah.
Okay.
Yeah, it should be. And so it's my contention that this is a very important recession for us to look at and study, because it was our first and largest, I shouldn't say first, our largest energy-based recession.
What about 73 and 79? Days of there of that.
Yeah, no, they were. Those were. Recessions? Yes.
Yeah, with huge oil price shock.
Yeah. Yes.
Engineer.
We started late. Can we save the comments to the end? Because we're going to run out of time.
Another, I think, important piece for us to understand as we build new models is we learned a lot in the 07-08, I think, about the relationship between income and energy consumption. Really quick, this is a plot of GDP to energy consumption. We know this. It has changed over time in terms of the trend. The most recent period of 1985 forward here, you'll see the slope of 0.47. The next slide I'd like to show you, I think, is really important and telling. So this is consumer energy expenditures as a share of total personal expenditures. And what I'd like to point out is in the last recession, you'll see that the cost of energy rose to a level that we had not seen since the 70s, coming out of a very, very long downtrend. And I think what's important to recognize at this point, this is updated through the first quarter of this year, is that energy has never been cheaper relative to our income than it is today. And so this is also setting expectations. Because buying gasoline and cars and driving and commuting and transporting ourselves around is not a cost problem. We can afford to ignore the problem. So I think a lot of times when we ask ourselves in here, why aren't people paying attention? Why is this not a piece of policy debate? Well, it's because people can afford to ignore it. Very simply. And we can continue to build roads. But it's my contention that when prices rose to a certain level relative to income, this is what triggered our recession. And so in building new models and looking at this, I think this is a very important thing for us to focus on, which is at what point were the issues of elasticity and income cause people to stop purchasing on the energy side. Of course, we had the crisis, and so we had to have a commission to study it. I thought this was very interesting. The report that was issued by the commission was 670 pages long. It's exhaustive. We spent a lot of time and money. I just wanted to run through the key highlights. There was failures in financial regulation, breakdowns in corporate governance, key policymakers ill-prepared, after all this, ill-prepared for what they had, and systemic breaches in accountability and ethics at all levels. You notice what's missing. There's not a single highlight that has anything to do with energy and the energy shock. And it's my contention that the analysis of these issues, it is all done by people in finance. And so they will tend to find problems that are all related around finance. So looking where we really have, only the light of day, but not what is out there that we haven't studied. I really like this for a Fed chairman that had actually done several interesting pieces of empirical work on energy. It caught him completely off guard. He really didn't take oil and energy into consideration. And in the aftermath of that, really didn't even have anything to say about missing that. Just hoped us well and hoped that mainstream America would get back on their feet. I thought this was another very interesting comment. Blanchard, a prominent economist, but even after studying what has happened with our models, we just can't let it go. And so I bring this slide up to talk about that these things are deeply embedded in the institutions, and they're deeply embedded in how policy is being made. And so to get a seat at that table, I encourage us to think that we've got to bring something better. We have to do a better job of modeling. There are some people now that are starting to speak up about these issues. Michael Munger, an economist at Duke, he's doing some interesting work on traffic and traffic economics. Hassenfelder, a theoretical physicist, doing some very interesting work in how physics has gotten off track with math-based models that are theoretical and that don't have an application to the real world. Joseph Stiglitz has a new paper out on the econometric models and their failings, which is a very interesting read. Campbell Harvey gave an address and gets into the pure statistical problems of economic research, p-hacking, these other things that are bringing up false outcomes for us to look at. And Judea Pearl, I think, is doing a very interesting line of work on causality. I think this is a really important thing for us to consider in model building, getting away from the statistical relationship and working on the math of causality. So this is actually a different line of math that brings that to the table. At the end of the day, the models need to be applicable to the real world, and they need to get us a seat at the policy table. And until we build those models and present them to the institutions, it's going to be very hard for us to get traction and make change. So to conclude our biophysical macro model, we want to start with a vision. We want to build off the operational details of the institution that we want to present it to. Let's get away from micro foundations. If we're going to have them in our models, let's at least get the relationships correct, as opposed to just making bad assumptions and telling people our model works because we do have micro foundations. Consider the macroprudential. These are talking about the things that maybe we can't capture in a model. Rather than having a model that is not complete, there might be things that we need to do on the macroprudential side. In the banking sector, this is the control of credit. It's the idea that no matter how we set the Fed funds rate, we can't keep banks from making bad loans. So it's a macroprudential issue that we have to get into the banks as a supervisor and come up with a policy to keep them from making bad loans. So something we can't control with policy that we put in this other bucket. That may be applicable to what we're doing with energy. And last is an area that I just have an interest in, is thinking about an energy price of money. We've come this far thinking of kind of 4 prices of money: the par price, the future price being the interest rate, the foreign exchange price of money, and a commodity price of money. But traditionally in banking, the commodity price of money has been gold, which obviously is gone. But perhaps we need an energy price of money, a new way to think about it.
6 megajoules per dollar.
Yeah, so it's not, in our history, we've been changing how money is valued. We've been changing the basis of money. There's no reason for us to think we can't keep evolving that and have energy at the table in that. So it's an area of the model building and research I have a particular interest in, and I think should be a part of it. So at the end of the day, we can have our models and we can have our expectations, but as we've learned, life doesn't always work that way and meet up to our expectations. And so we can't throw out judgment and good homework. And I'm happy to share the reference of it.